Hi, in this section of videos I'd like to talk about valuation, and we're going to cover a number of topics that relate to valuation. But the first thing that's worth saying and drawing back to is this concept of market efficiency. Because when we talk about valuation as it pertains to stocks and financial markets, and in particular because so many different market participants look at these items, i.e. so many different analysts and portfolio managers, traders, private investors, institutional investors, look at and analyze the valuation of a given stock in a developed market, for example in the US market or a stock in the S&P 500. Many people argue that markets become efficient, meaning that the effort that we put in to figure out what the valuation of these stocks is to a large extent reflected in the price of that security, and by doing this analysis, because so many people are doing it, we're unlikely to gain additional information that will make us outperform the index. So it's very important to understand that the valuation is something that we can get our heads around, and we can learn about the terminology and understand how stocks are valued and the general principles behind it and do reality checks. But many studies have proven that conducting detailed valuation analysis on securities does not over the long term lead to outperformance of the index or of a benchmark in a developed market. And that ties back to this concept of market efficiency, and also ties back to the usefulness of index funds for many people in that they are lower cost, lower fees, and mean getting the performance of an index as opposed to trying to outperform a benchmark, which over the long term is impossible at a higher cost with higher fees. So that's the introduction to the concept, to this whole section on valuation. We're going to cover a number of topics on valuation. And when we talk about valuation, we're talking about trying to derive what the value of a particular security might be using different methods. All of the methods have advantages and disadvantages. Some are more difficult to calculate and some more easy, and we'll see that as we get into the discussion. When we're talking about valuation, typically we're talking about valuing the future benefits that an item would provide. So in the case of a stock, as an individual owner in a stock, the future benefits to us are the dividends that that stock will provide, and the difference between the price at which we buy it at and the price at which we sell it at, adjusted for time. So if we buy a stock for $10 and we sell it at $20, then we have a benefit of $10 over that time period, plus any dividends that we might have received. Now, when we talk about valuing anything really, including stocks, but also any purchases that we make, we're always talking in general about valuing the future benefits that that item might provide. And so that's what we have to bear, is one of the things that's very useful bearing in mind. And it ties back to a number of the valuation principles that we're going to discuss and a number of the valuation methodologies that we're going to discuss. In particular, for example, the discounted cash flow method, where we look at future cash flows that accrue as benefits to a company and how we can value those into the future. But in general, when we think about buying anything, whether it's a piece of art or a furniture, we're typically comparing what the benefits that that item might provide, how they compare to the cost of that item, or how they compare to benefits that other items might provide at a similar cost. And then we can ultimately make an informed assessment of whether those future benefits outweigh the cost of that item today. These future benefits have to be adjusted for time, and that's one of the key principles also behind a number of the valuation methods.